Muted.
All right, now we're now recorded. All right. First of all, good evening to everyone here on the call. For those who do not know me, my name is Cedric Jenkins, proud owner of my econ, and tonight we are talking about investments, okay? And initially I did this for the business owners, but I also wanted to open up to guests as well because everybody needs to know and understand about investments. And why we talk about investment is because investment is the income we're going to be living off of in our retirement years. So we want to get a good general understanding, and I want to emphasize general. All right, so let me go ahead and put out my disclaimer right now before we even get started. I'm not a financial advisor. Okay? I'm not a financial advisor. As a matter of fact, we do have a financial advisor who's also our business partner on the line, Mr. Bob Crane. So if by chance there are some financial questions that needs to be answered, we do have a certified person on this call that can answer those questions. But Cedric is not a financial advisor. What Cedric is a wealth educator. So I'm going to give you enough information to where you can understand investments, to where now you can go hold a conversation to the Bob Cranes of the community, all right? So all I'm doing is just passing on some information about investments, all right? So why are we talking about investments? Well, understand this. Everybody has two objectives, or shall I say financial objectives, when they wake up in the morning, and that is to earn enough money in their current lifestyle while simultaneously take that same income and fund their investment. Because at the time where we're getting ready to, or when we live in our retirement years, we still need income for our retirement years. Here's the question. At what point can we ever say we no longer need any money? That's a question that we all have to ask ourselves. At what point can we say we no longer need money? I think we all will agree that we all need money until we no longer breathe, because we don't live in a free society, right? So we all need money, even in our retirement years, all right? The question is, in our retirement years, what kind of income that's going to be coming in to sustain to have the same lifestyle that we had in our current years for our retirement years, okay? So we have choices. We have our retirement that we may get from our jobs. We also may have Social Security, but of course we all know about Social Security. It ain't going to be enough. I'm a testimony to that because my parents are strictly living off of Social Security, and I'm gonna be transparent with y'all because I'm being transparent about my own personal financial journey, and that is my parents are just living off of Social Security, and it ain't enough. So I get a monthly phone call from them saying I need to borrow some money. All right. So Social Security is not enough. So we need to find or understand. If our lifestyle in our current years is based off of $5,000 a month while we working, we need that same $5,000 in our retirement years. Where is it going to come from? That's a real question we all have to answer, okay? That's the question that we all have to answer. Let me give you some known facts, and then we're going to get started. Here's a known fact, right? The IRS you got three types of incomes that the IRS recognize, okay? Hold on for a sec. All right. So going back to what I was just saying, the IRS categorize income in three categories, and here they go. You got active income, you got passive income, and then you have interest income. So what is active income? Active income is basically nothing more than your wages that you get from your job, tips if you're a waiter or something like that, salaries, commissions, and believe it or not, Tax savings is another form of active income. All right. Now, active income is in a certain tax bracket, right? It's taxed between 28 and 33%. So that's active income. Passive income, that comes from rental properties or business, all right? So if you have either a business or a rental property, that's where your passive income comes from. And lastly, interest income. We all know interest income comes from investments, which is tonight's topic, all right? Now, going back to passive income, the tax bracket for passive income is taxed between 18 and 23%, and then interest income is taxed at 15% or less. Now, interest income, that's where your money is being taxed, okay? 15% or less. Hence the reason why we all need to try to strive to become an investor, because it puts us in a lower tax bracket and your money can work faster because of the way that it's being taxed, all right? In addition to compound interest, the way it works. And we're going to go over that shortly, okay? So here's the thing. If you want to have a recession-proof economic model, you want to have all three of those sources of income: active, passive, and interest income. All right? You want active, passive, and interest income in order for you to have a recession-proof economic model. All right? That's basically what we want. What we want to have. See, it doesn't matter what the economy is doing, right? But it really matters what we're doing within the economy. And so if we're doing or trying to get these three sources of incomes, then now we don't have to worry about the economy. But see, we got to get to a point to where we're doing those things. So let's just talk about the one source of income tonight, which is interest income, which comes from investments. All right, so let's get started here. I just want to hit on that high note right there. Let me get this going. So why are we here? Here's the purpose of why we're here. We want to understand that if we investment is nothing more than an income-producing asset that helps us generate wealth, right? We want money working for us while we're sleeping, right? That's the whole purpose of us talking about investment tonight, is to understand that we need to have income-producing assets that's going to be generating wealth for us, and also give us a lower tax, help us with our lowering our tax liability. All right. So why do we invest? At some point, we no longer either want to punch a clock to go to work, or our health is not going to allow us to no longer go to work, or our job is say, hey, here's a pink slip. We no longer need your services. So we have to get to the point to where we want to have investments working for us where it's still generating money for us. All right? So, can everybody see the handout? There should be two handouts. One is the EDM worksheet. If you will, go ahead and open that up, because we're gonna go over something that's called the Rule of 72, compound interest. If you open that up and go to a sheet that's called the Banker's Secret, all right? I'm going to give everybody a little bit of time to open up that document under handouts and go to double click on the EDM worksheet 2015. All right, has everyone got a chance to open up that document? Okay, Derwin said he's having a problem. He's having some problems opening it. Anybody else having any problems opening it? If not, that'll be okay if you're not able to open it. All right, let's move on a little bit further. All right, compound interest, rule of 72. So as you can see, this goes way back to Albert Einstein. He called compound interest the greatest mathematical discovery of all time. And so what happens is there's a formula that is used to determine how many years it takes for your money to double. Your Federal Reserve use it. Your banks use it. Wall Street uses it. Anyone in the financial services know, use, and understand the rule of 72. Okay? So we're gonna show you how the rule of 72 works and how you can see where money can be doubled just by using this formula, all right? So again, if you're not able, let me see. Okay, but second one. Okay, all right, Darren, I'm following. All right, so this is what that Banker Secret worksheet looks like on y'all end. So if y'all not able to see it, y'all can just follow along with me, all right? So the Banker Secret, what is it? So we're gonna talk about the rule of 72. Now here's the formula. It's 72 divided by the interest rate equals your money's double. Okay? Take a snapshot of that. 72 divided by the interest rate equals your money double. Okay? Now, we got, in this example, we're going to show 3 different people who's going to go through this rule of 72. They all going to start with their own initial $10,000, but they're going to have different interest rates or rate of returns, and you'll see the difference here shortly. All right, so let's go with the first guy here. First guy's going to get 4%. Second guy going to get 6%. Third guy's going to get 12%. All right. Now, first guy. Remember, looking at the formula, 72 divided by the interest rate equals your money doubles. So the first guy has 4%. So for every 18 years at 4%, his money is going to double every 18 years. So you plug in the number, 72 divided by 4% equals 18 years. That's for the first guy. Second guy, 72 divided by 6%, which basically means his money is going to double every 12 years. All right? Last guy, 72 divided by 12%, which means this guy's money is going to double every 6 years. All right? First guy, he's going to start off with an initial $10,000 into an investment portfolio. At 4%, right? Remember, his money is doubling every 18 years. So at age 47, his money is going to go from $10,000 to $20,000. Then when he reached the age of 65, his money will double from $20,000 to $40,000. Everybody see that? Okay. Let's look at the second guy. He's going to start with $10,000 as well. But his money is going to double every 12 years. So at age 41, his money is going to double to $20,000. Now look in comparison. Now, the first guy, when he reached 47, he got $20,000 at 47 years old. The second guy at 6%, which is a 2% difference, he got $20,000 at age 41. So that's 6 years difference, right? So you see that. Age 53. Now he reaches $40,000, whereas the first guy, he didn't get $40,000 till he got to age 65. See the difference? And then finally at age 65, his money doubles to $80,000. So after it's all said and done, a 2% difference between the two, the second guy has $40,000 more than the first guy, just off of a 2% difference. Everybody see that? Okay. Last guy. You're going to start off with the same $10,000. But his money is going to double every 6 years. So let's look at this. Age 35, $20,000. Age 41, $40,000. Age 47, $80,000. Age 53, $160,000. Age 59, $320,000. And finally, age 65, $640,000. Now look, y'all, this guy here at age 65 has $600,000 more than the first guy. Why? Because he has a higher rate of return of 12%, which means his money is doubling faster. All right? His money is doubling faster. So here's the thing. We used to having savings accounts, right? So when we put our money in a savings account, understand that the banks are not giving you 4%. Now, we're being modest when we're saying 4% for the first guy, right? But if you put your bank in a cash equivalent product such as a checking or savings, and we're going to talk about that here shortly. While you're putting your money in the bank is getting 12% on the money that you deposit, and they're making money off of your money. They're getting the interest off of your money while you're getting 4% or less. Okay? That's what's happening in the marketplace, right? So we had to get to the point to where our money should be working for us, but just know your money is not working for you sitting in a savings account. It should be working for you. It'll be working for you if you have it in an investment portfolio. That's where the financial advisor will come in and give you sound advice as far as what investment portfolio to pick. All right? Any questions with what you see here as far as the banker's secret? Everybody understand the rule of 72. Basically, 72 divided by the rate of return equals the amount of years your money will double. So I'm gonna pause right here for a second. Any question? If you do, raise your hand, and then I'll take you off mute, and then I'll go ahead and let you add a question. Or you can chat. You can put your question in the chat box. Can y'all still hear me? Can everybody still hear me? Somebody chat in the box and let me know y'all can still hear me. All right, thank you, Mr. Crane. All right, so we talked about putting your money in the bank, which is called a cash equivalent product, right? So let me go over and talk. Let me go over about what is cash equivalent. As a matter of fact, let me go over what we call the 4 quadrants of the financial industry. Right? There are 4 quadrants, and I'm going to talk about the first one here. First quadrant is what we call, like I mentioned earlier, the cash equivalent quadrant. Well, what make up the cash equivalent quadrant? Checkings and savings, as I mentioned. These are low-bearing interest products, as well as CDs, money market, savings bonds, U.S. Treasury bills. I will give you my own personal testimony. I have, for those who are familiar with Regions Bank, my wife and I, when we got married 17 years ago, we had some play money, like $1,500, and we went and bought a Regions CD with the $1,500. So I think it was last year, it was time for it to mature. After having this CD for about 15 years, when it finally matured, it only matured about right at $143 after having it for 15 years. Well, why only $143? Well, the rate of return on that thing was 0.67. Let me say that again. The rate of return, or the interest rate on it, was 0.67. So if you was to plug that rate of return in and do the rule of 72 on that, now don't even waste your time, because here's the thing: if you do a rule of 72 on that, you'll never see this money grow at that rate of return. We barely saw it grow at 4% on the last example that we showed you on the Banker's Secret. So just imagine at 0.67, my children's children would never see that money grow. So you see what I'm saying? If you put your money in what we call this quadrant, a cash equivalent quadrant, you'll never see your money grow. All right? This should be nothing more than a temporary holding spot to move your money from this spot to somewhere else where your money is going to grow faster. All right? But this is what we call quadrant number 1, cash equivalent. Okay? It's designed for short-term use. It's accessible 24/7. But consequently, the rate of return is less than 2%. All right? The rate of return is less than 2%. Let's go to the next quadrant. Quadrant number 2, we're talking about stocks. What are stocks? Well, this makes up stocks. We got pre-initial public offering, pre-IPO. Then we got IPO. This is when it goes public. Then we got secondary marketing. Then we got marketing caps. Okay, so these, and I won't go too much in detail in this. As a matter of fact, let me say this, and then what I'm going to do is Mr. Crane, are you still on? Hold on, let's see. I'm going to take Mr. Crane off of mute here.
Can you hear me now?
Okay, Mr. Crane, are you there?
I'm here.
Mr. Crane.
I'm talking to the phone.
Okay. So coming back, so in the stock, in this quadrant here, your rate of return is, can I hear you there, Mr. Crane?
Yeah, I can hear you loud. Can you hear me, sir?
Okay, I took you off mute because I want you to elaborate a little bit more on this, okay?
All right.
Hold on.
Which
So
parts? Right?
so here, this is what we're talking about. Oh, wait a minute, I got a feedback here. So as you can see, in quadrant number 2, this is where we want to invest in. And as you see in my notes, right? And we talked about this, or this was brought up. As a matter of fact, Mr. Bob Crane can talk a little bit more about being a qualified investor and as far as getting early in on the stock. Mr. Crane, are you there?
I'm here.
You want to talk a little bit about that to the audience?
All right. The way they qualify to be a credit investor is that you have to have at least a annual income of $250,000 a year, or a gross net worth of $1 million, not counting your primary residence. Now, right now, going through FINRA, they are looking at changing those requirements to lower them, but we won't know anything about that probably till the fall.
Okay.
I mean, when you do things like initial public offerings, the reason they're keeping that high, and these rules were made back in like 1933, and they really haven't changed. But there's a move now to lower them, and we should see something coming out of Congress to the SEC to do that. They're looking to reduce net worth down to $500,000 and gross income of about 175 to 200,000. But if you hold financial certifications, you may be able to be exempt from those. That's what they're working on right now.
Okay. Talk a little bit more, if you will, about pre-IPO, IPO, secondary marketing, if you will.
Okay, pre-IPO is they don't advertise it. It's normally institutional investors like your nonprofit foundations, your private hedge funds look at that. People that have been in that business or have the sophisticated investor net worth of $1 million or more can get offered an opportunity to buy before a company comes public, before it's launched. The IPO, public offering, is commonly think of when Facebook went public. That's initial public offering. You have large companies that do it. You have small companies. We're seeing when the economy is bad, you don't tend to see that many IPOs come out. But when things start getting up, you see companies gear up for it. They don't have to be the Amazons of the world, the Facebooks of the world. You'll see smaller companies. A lot of your new biotech pharmaceutical companies, or some of these Silicon Valley computer companies, do IPOs. And you can get in on those through your broker, if a broker dealer is selling them. But now there's some things out there in the internet that actually will sell IPO offerings directly to the public if they file that way with the SEC.
Awesome. So you're hearing it from a financial advisor as far as what are pre-IPOs, IPOs, and secondary marketing. Again, Cedric is not a financial advisor. He's just a wealth-building educator. But we have people on this call who are specialized in this area that can pretty much explain the market and how it works more so than I could. But what I wanted to do is just kind of facilitate the information to you all, so that way we can kind of look at our personal finances at a better view. Okay.
You want me to go on to number 3?
Yes, sir.
All right. Your secondary markets is everything that's come public that sells on the New York Stock Exchange, the NASDAQ, some of the over-the-counter stocks, OTCs, that stock that's already out there. And you buy it based on its daily ending share. That market price on a stock would change every day, whether it's Coca-Cola or Southern Company, Aflac, and you can buy that uh, through a discount brokerage firm. Some of the companies actually let you buy directly from them, and that's a good way to do it because you don't pay any commissions. I see here
Mm-hmm.
common stock, preferred stock. When a company issues stock, equity offerings, what that's called, they'll have normal common stock. Before that, what's a little bit higher is preferred stock. Preferred stockholders get paid dividends first, and normally it's a fixed rate. And some of it is just preferred stock. Sometimes it can be converted to common stock. Common stock was by and large what most companies offer. And then you have different categories, like your blue chips are your big Fortune 100, your Coca-Colas, your General Motors, General Electric, like Delta Airlines, Pfizer, Merck, AstraZeneca. These are big companies that are doing good times and bad times. They tend to do fairly well. Their stock is very stable. I think the next one you had on there was growth stocks. Growth stocks, you're buying companies that are up and coming. They don't pay a lot of dividends, but you're investing in them to see the value of the stock go up. And then you have what they call income stocks. Income stocks are stocks that pay high dividends. Your utility companies, like Southern Company, which is Alabama and Georgia Power, is that their stock price tends to stay pretty same, but they pay a high dividend every year to their customers. So it's a good stock for retirees to have, preferred stock and income stock, because it pays a good dividend for income. Your value stocks, these are companies that are out of favor or industries that are out of favor. In other words, their value is lower than what it should be. And this is where Warren Buffett, with his Hathaway Corporation, made all his money. That he would look for companies that were undervalued, that their industry, whether it was auto or pharmaceuticals, was in a downturn. He would buy those, and as they would come back, they would gain value a lot sooner than other stocks. Your cyclical stocks are stocks that tend to show over the years an up and down rhythm that moves with the seasons of the year. Example, construction company stocks tends to be a lot higher in the spring and summer, and go start going down in the fall and tend to be low so they're winter when there's less construction. Your defensive stocks are stocks that do well during downturns in the economy. And I always tell my clients people have to have food, they have to have electricity, they got to have gas for their car, and they got to have medical care. So those big 4 areas are defensive stocks. Think like General Foods, Exxon, your pharmaceutical company stocks, your electric companies, your gas companies. And then sector markets where they invest in certain sectors. Like you might have a sector where you invest just in energy stocks, just in technology stocks, just in heavy industry like steel or automotive or oil and gas. Let's go on to number 4, your market cap stocks. You got large, middle, and small. Small companies, small caps are considered normally under 1 to 2 million or less. Mid companies will be from 3 to about 10 million. Large will be from that 10 to about 50 million. And then your conglomerates will be 100, 200 million or more. The larger a company, normally the more stable that is. Your large cap stocks would tend to be in your defensive areas or sectors or income sectors, while small company stocks would probably be in those growth and value areas.
Awesome. So go back and elaborate a little bit, or talk about the advantage of being able to be a qualified investor. What does being able to be a qualified investor do for an investor?
Well, I'll give you an example. Being a certified financial planner that I am, I get all the pre-IPO offerings and IPOs coming out because I've got clients that meet those terms. So they tend to go out to broker-dealers, CFPs like myself, wealth managers first to see if we have clients that are interested in that. It gives a chance to get out on a stock that's coming public at the ground floor. And that can be good and bad. Example, when Facebook came out and I saw what the IPO offering price was going to be, I told a lot of my clients, that's way too high. It should have been about $10 to $15 less. Some people believed me, some did not. And, over that next 6 or 7 months, it dropped substantially. It finally came back up. So, not all IPO offerings, the price that they set is what the value of the company. Sometimes it's too much, sometimes it's too little. That's where you can make a good pop and some money when it first comes out.
Mm-hmm.
Pre-IPO are people that are buying stocks in the company directly, but they're normally buying in blocks of 100, 500,000 to $1 million. When IPOs come, you can pretty much buy what the offering price. The stock is $20. You can buy one stock, but they tend to sell it in blocks of what we call 100. So 100 shares tends to be a normal trading block for an IPO. So if it was $20, 100 shares, it'd be $2,000.
So everybody can see what happens is, if you're a qualified investor, you pretty much will have first dibs or have the first say-so on a pre-IPO, right? So if the price is right, and you're a qualified investor and you invest in basically a pre-IPO is nothing more than an idea, folks. That's all it is. That's about to go public. And listen, you hear Mr. Crane give you some good wealth information, and I don't want y'all to think that or get overwhelmed about the information, because here's the one rule that everybody needs to know about investing. There's two things that you're trying to beat, and that's taxes and inflation. All right? Taxes and inflation. Understand this. Inflation will probably fluctuate as high as 4%, give or take. So if you're trying to outpace inflation, and you're an investor, not qualified, just say that you're just an investor, you want to be able to outpace inflation. We already know the inflation rate will top out at 4%. So if you're going to invest in anything, you don't want anything less than 8%. Why 8%? Because it doubles the rate of inflation. Question: if you know the inflation rate is 4%, and you have an investment vehicle, whether it's a CD money market or what have you, at 4%, are you going to see your money grow? The answer is a resounding no, because they'll flatline. The inflation rate is 4% and your investment is 4%. You will never see your money grow. Okay? So that's why you want anything that if you're trying to look at an investment portfolio and you're talking to the Mr. Bob Cranes of the world, you need to let the financial advisors know that you're trying to look for a portfolio that's going to outpace inflation. Just know the rule that inflation tops out at 4%. Okay? So don't let this information intimidate you, because that's what the financial advisor is there for. You just need to know, as an investor, you just need something that's going to outpace inflation. And chances are the financial advisors are going to know what to at least advise you a portfolio to help you outpace inflation. Okay? All right. So he just gave us a good wealth of knowledge on quadrant number 2, which is stocks, pre-IPO, IPO, secondary marketing, and marketing cap. All right. So let's go to the third quadrant. Okay. Bonds. Here's what you got in bonds. Corporate bonds, municipal bonds, mortgage-backed securities, U.S. government-backed securities. Okay? Now, Mr. Crane, now correct me if I'm wrong here. On these bonds, can a customer, can any of your clients find bonds at 5% or greater?
You can. When you're looking at bonds, they're very sensitive to interest rate changes. And the old saying, higher risk gives you higher return. Same you have in equities for stocks is the same for bonds. A higher interest rate may mean a bond that has more risk. Example on here, you got corporate bonds, you have in parentheses junk bonds. Investment grade bonds are B plus or better. And you might say, well, who rates those? There's a company called Moody's. Moody's has been out there forever. They rate all corporate and government debt. They're the ones that downgraded the U.S. credit rating from AAA to AA. So all the deficits were running. So Moody's, and there's a few other companies, Dun & Bradstreet, rate all the bonds that are issued at our company. So investment grade is B plus or better. Anything below that, when you get to C bonds are considered lower junk that could go in default, and D is default. And it happens sometimes. I mean, you have some municipal bonds like Puerto Rico right now. Puerto Rico bonds right now have been downgraded to C. They're on the verge of default, which is because they're just out of control spending and they can't pay their interest on it. Corporate bonds, depending where you live, you'll pay possible federal tax rate and state income tax. Municipal bond, where you live, normally, like in Georgia, if you buy a Georgia municipal bond or an Alabama municipal bond, you live in Alabama, that interest will be state tax-free, but won't be federal tax-free. When you buy U.S. Treasury bond, Treasury bills, Treasury notes, those will be, Treasury bonds and notes, excuse me, will be federal tax-free. You have to pay state income tax on them. Now, if you live in a state that does not have state income tax, then you wouldn't pay tax on them at all. Like Florida, Wyoming, Texas, Tennessee, Nevada, Alaska, and a couple others. Your municipal, you can buy corporate bonds for $1,000. That's called par price. And what happens, let's say you have a corporate bond, it's $1,000 par, it has a 5% interest rate. Well, if interest rates go above 5%, the value of that bond drops. So if you had to sell that bond and interest rates are at 7% and you're at 5 and your bond makes 5%, that bond will be sold at a discount to equal that 7%. So basically, that $1,000 bond would sell for about $800. But if you have a 7% bond and interest rates drop to 5%, you probably would get $1,200 for that bond if you sold it because it's selling at a premium. But if you're holding on to bonds to earn the interest rate until they mature, you don't worry about that. And municipal bonds work the same way, except normally the minimum price is $5,000 to buy a municipal bond. Now, mortgage-backed securities. You know the big ones from the financial crisis back in 2008. Fannie Mae and Freddie Mac and Ginnie Mae. Those were the three big government-backed agencies that buy all home mortgages and sell them in the secondary market. Those are mortgage-backed securities. Those are also the same debt instruments that they did with non-government-backed that were sold as being investment grade and turned out to be junk. And when everyone stopped paying, they collapsed. Now, your U.S. government-backed securities are those that are backed by the full faith and credit of the U.S. government and the Treasury. Obviously, Treasury notes, Treasury bonds, Treasury bills, a lot of your transportation bills, anything that's funded directly by the government. I might add, if you all have any questions, Cedric, can I give them my website to the Resource Center?
Go ahead and put it in that chat box for them.
Okay, I will do that. If you go there, I've taken the password off. I've opened it up to everyone who's listening to this call and who's also a member of my econ. I have a Resources Center. In there you'll find articles, newsletters, glossaries of anything financial you'd like to know, and can answer you a lot of questions.
Okay, awesome. Yeah, if you will, Mr. Crane, go ahead and put all your contact info in the chat box so the audience can have a way of getting in contact with you, and as far as viewing your resources. I personally visited, and it's a wealth of information out there for our brain as far as improving our finances financially, right? So if you get time, go out there and check it out. Say that again.
I'll put it in I'm putting it in now.
Okay. All right. So while he's doing that, let's go to the last quadrant, all right, which is real assets. Quadrant number 4, real assets. What are real assets? Nothing more than rental property, private businesses, collectibles, yes, even art. And lastly, furniture, commodities, cattle, gold, oil, silver, etc., etc., etc. Okay? This is what we call real assets, something tangible, right? Okay? So these are your 4 quadrants. So just a recap, quadrant 1 is cash equivalent. Quadrant 2, your stocks. Quadrant 3, your bonds. And quadrant 4, real assets. And so the way that and here's the thing. I want y'all to understand this. Money is a tool, but money never sits still. Okay? At the end, and y'all seen it on Wall Street, right? To where that when they ring that bell, that means they're about to close the market. When they close the market, you can rest assured that money is about to be redistributed to someone, such as investors, to where that money is about to go to work for somebody. So the question is this: when the market closes, are you receiving any of the money from Wall Street? Okay? That's a question that we all have to ask ourselves. When the market closes, are we getting a piece of it? If we're not, we need to reposition ourselves to where now we have the marketplace working for us. Okay? We want to have the market working for us when the bell rings. And I'm going to tell you that you don't want to have your money in quadrant 1 when the bell rings. When the market closes, your money needs to be in quadrant 2, 3, or 4. Remember, all you're trying to do is beat two things, taxes and inflation. All right? That's all you're trying to do is beat taxes and inflation. Just remember, inflation tops out right at 4%. So if you want to be an investor and you want to see your money grow, you don't want anything less than 8% when you're talking about investing in something. All right? So the way that investment income is paid out in two different things. First thing is dividends. All right? That's basically a sum of money regularly by a company that's paid to shareholders. Then the next one is capital gains. All that is a profit from the sale of property of an investment. Those are the two ways that interest income is paid out: dividends and capital gains. All right? So we've come to the end of our presentation, believe it or not, okay? But I want everybody to understand that we all need to position ourselves to become an investor, because when we're no longer working, we still have to have income coming to us, right? Remember, if you want to have a recession-proof model, you have to have 3 sources of income: active income, passive income, and interest income. Interest income is what's going to keep us going after we no longer have active or passive income. Okay? If we no longer have active or passive income, we most certainly need to have interest income, because of the fact that's ultimately where we're going to be living off of in our retirement years. All right? Y'all always hear me say, if your money isn't working for you, it simply means it's working you. But we have to change that. We have to change our mindset. We have to change the way that we have a perspective on how money works. We just have to change our whole outlook of how money works altogether. All right? And once we get the right perspective, we get a different outlook. Then once we get a different outlook, we can get different outcomes. But it first starts with us, how we look at money. All right? So what I'm going to do is, this is questions, comments, and concerns. And what I'm going to do is I'm going to open it up. Give me a second here and allow some questions, comments, or concerns to come in for about the presentation. All right? So I'm taking y'all off of mute one by one. And if you have any questions, comments, concerns, now is your time. Everybody's off on mute now. Any questions?
Okay.
Hey, questions?
Huh? Oh, I don't know.
Say, Cedric, while we wait for some questions, I'd like to add a couple things. Is that, saving your money on taxes, getting your W-2 right, getting your allowances right, will give you some immediate money to pay down your debt. The first thing you need to do on your key to move into wealth management is you got to get your debts paid off first. I've had clients that they're like, Well, I'm earning 11% on $20,000 in income off stocks, but they've got $20,000 in credit card debt at 23%. So they're actually losing 10, 11% of their money. Better to pay off that debt first. Stop paying the man. And once you pay off your debt, then you unburden yourself. You break those bonds of debt, and then you can do anything. And then you start moving to build your emergency fund, have 6 months' salary in the bank, and then you're able to start investing.
Ms. Crane, that's a good point. There's been a lot of questions asked about. I know when I first started my econ, as far as how soon should we start investing? And you just brought up a good point about the path of getting started. And basically, we really can't talk about wealth building until we eliminate debt or get debt out of the way, right? The second handout that y'all should have, if you can't see it, if you can't pull it up, I do have it pulled up, but what it is a strategy plan for folks to where Mr. Crane alluded to earlier about starting an emergency fund. And here we have like 8 steps into getting that plan. He just mentioned about adjusting. Look at step number 1. Adjusting your W-4, okay? And so we're talking about here, let's not overpay in taxes. Let's get the tax dollars that we're overpaying and bring that back into your household. Let's pay less taxes. Now let's take the tax dollars and let's start doing some debt elimination. That's what I did. That's what I did. I was overpaying $1,100 every month for 20 some odd years. And basically, I just gave away $375,000 and over that course of period of time. So now I'm bringing that. I brought that back, which allowed me to eliminate right at $35,000 worth of debt within 2 years. But also that helped me when I did that. When I started freeing up debt, now I was able to go start or open a mutual fund and 3 IRAs. And at the time when I opened them up, the rate of return on it was 19.57%. Now, you do the rule of 72 on that, that money is doubling every 3.5 years, roughly. But I wasn't able to do that until I got rid of some of my, okay? So that's what Mr. Crane was talking about there. First, start at your W-4. Let's see if you're overpaying in taxes on the W-4. If you are, let's bring them tax dollars back into your household. Put your money to work. Now, put it on that book that you have, and then now let's start building up your emergency fund. Okay? After you start building up the emergency fund and getting it where it needs to be, now let's move on to the next thing. Let's look at an investment portfolio. Okay? But hold on. So this document here, if you're looking at steps 1 through 8, that pretty much give you a roadmap, step by step, ABC 1, 2, 3, of how you can accumulate assets. Okay? And as you can see, the first step is minimize your taxes. All right? Minimize your taxes. And if you're able to do that, then it will allow you to get to step 8 to start building your investment portfolio. It doesn't matter, and you can talk to a financial advisor on what portfolio that you need to invest in order to get your money to grow. But there's various options there. As you can see, stocks, bonds, real estate, mutual funds, ETFs. As a matter of fact, ETFs. For those who follow me on Facebook, y'all know I'm always putting some out there about Acorns. There's another one, Mr. Crane. What was the other one that somebody had a question about?
Stash.
Stash. I
Stash is
didn't
another
know
one.
anything about
Uh,
that one, but that also deals with ETFs as well, right?
it allows you to invest into individual stocks that are you can buy directly through the company. And a lot of them have joined Acorn and Stash where you can do that. You can also do some ETFs and index funds also.
Gotcha. Gotcha. So with me, I use Acorns, and what it does is it allows me to do some investment into ETFs. Okay, something simple as that, right? All that means is you just want to have something going. You want to have your money being transferred to somewhere else to where it's working for you, to where you don't want your money being transferred to somebody else where it's working for them. All right. All right. Any questions? I got the mic open for anybody and everybody. So if you got any questions, go ahead and hop on the mic.
Cedric, while we ask for questions, let me add one thing to the group.
Okay.
Ladies and gentlemen, there's a lot of people out there that will call you on the phone, that will send you an email on wonderful deals that look too good to be true, and they usually are. There's a lot of con artists out there. There's a lot of people that call you, try to sell you oil and gas development programs. They'll try to sell you some high yield interest on a company. Before you buy, before you send any money, ask some simple questions. If they're selling oil and gas, they got to be registered with FINRA and the SEC to do that. You have to have licenses to do that. They're not willing to give you what those license numbers are, hang up. You know, a lot of people get taken in. There's a lot of fraud in the investment world. There's people out there that are hawking penny stocks. Penny stock industry is highly unregulated. And a lot of the companies that are out there sending emails out and have these fancy video presentations, if you read their fine print, they're actually paid by the companies that own the penny stocks to go out there and market and kind of push the limit of all the positives and really not talk about the downside and the negatives. Before you buy anything like that, talk to someone who you trust who's got credentials. They're a registered representative, they're a certified financial planner, chartered financial consultant. No, a CPA or someone you trust who's been a bookkeeper for a long time. But if you don't know these people from the bum off the street, and you, like Ronald Reagan would say, you need to trust but verify. But before you send anything, check them out.
Okay. Thank you, Mr. Crane, for that. Is there somebody with a question?
No, me for now.
Mr. Kevin. Kevin Thompson, can you hear me?
I can hear that crap in the bathroom.
That's it. You have to mute everybody.
I can hear that.
Hold on. Right. Okay, can you hear me? Mr. Kevin, can you hear me? You're unmuted, so I'm not real sure if you connected via the web or on the phone. If you're on the phone, you should be able to just unmute yourself on the phone. If you're on the web, then you should be able to unmute. I got you unmuted. If you if you will, go ahead. Okay, hold on. Let me see. I got your question here. I have not started investment yet. I am at the point, but do not know where to start. I'm 50 years old and concerned because of time factors. Okay, so Mr. Crane, you want to address Mr. Kevin Thompson's questions there? He said he hasn't started investment yet. He's reached the age 50. He's kind of concerned. So I think he's kind of concerned about the timeline and whether or not he thinks he's too late to start investing.
Well, you're never too late to start. I mean, he's age 50, so he's got probably another 15 to 17, 18 years of working. So if he's working for a company, if you're working for a company, sir, that has a 401k or pension profit share plan, if you're in a position to do so, max out what you can with them. Depending on the company, some will match up to the first 3 or 4% of what you put in. They'll match at 50 cents to the dollar. So if you put in 3%, they'll match that with another 1.5%. But if you can max that out, the most you can put is 15% of your income. That's 15%, and one's not going to get taxed anymore. So that's going to earn tax deferred. Sorry about that. I've been under the weather for a few days. So I say that's one thing you can do. Another thing you can do is that get your debt structure right, get everything paid off first, and that's going to free up money to be able to invest. And go to my resources center on my website. I've got hours of stuff you can look at, and you can just really learn a lot. If you have any questions, do give me a call.
Awesome. Thanks, Mr. Crane. All right. Are there any other questions? If you will, chat it in the box, and then what I'll do is I'll read your question out loud for Mr. Crane for you. Any other questions?
I can't see.
Any other questions?
Don't be shy now. Normally you have to pay to get this type of investment advice when you go see someone. You get it for free tonight.
I know, right? Well, look, if there is no other questions, I want to go ahead and again thank everyone for being on the call. Mr. Crane, I personally want to thank you for joining. I was hoping that you'd be on the call tonight, so that way you can probably answer some of these questions that Cedric can't answer, because again, I don't have a Series 6 license, so I'm not authorized to give out any advice. However, you are. So I want to personally thank you for being on the call today and being able to address any kind of investment questions that they may have, okay?
It was my pleasure. Anytime you need me in any interview that do join the organization and have calls and would like to have me on, I'll be more than happy to help support what you're doing.
Thank you, thank you. As a matter of fact, I will be planning on getting back into more webinar training and more calls, and we do need more of these type of calls when we're talking about wealth building, because that's why we're here, is to talk about how to improve our personal finances. And we have to have an open conversation about these kind of things. A lot of us like to go set up in a corner because of the fact we're kind of too embarrassed to talk about our financial state. But the only way that we can get there is to have a conversation and be honest with ourselves. Where are we right now currently with our finances? And secondly, where do you see yourself in your retirement years when the time comes? Can we honestly say we have something set aside or working on something to where in our retirement years we no longer have to worry about income, and income is going to be coming into us when we no longer punch in and out of the clock to go to work? Because at some point we no longer will be working. When we start working, we have to figure out where that money is going to come from. All right. So At the end of this call, you'll see like a survey. Please fill out the survey. Be brutally honest about tonight's call, whether or not if you got value added or not. Just tell me exactly what it is that you didn't get. Tell me exactly what you did get, and the information that you didn't get. Then I will make sure on the next time we do a webinar that I'll make sure I have that information where I can get that facilitated to you all. Okay. All right. So again, thank everyone for coming on the call, and we're gonna jump off. Y'all have a good evening. Okay. Talk to y'all later.